Welcome to the podcast and on video in full Technicolor. I'm joined by equity analyst, full-time investor. He's a man who's a genius of talking figures, spreadsheets, calculators. He's a human walking, talking calculator spreadsheet. And I can see he's got the suit on top. But are you wearing, I imagine you got some Bermuda shorts below the desk as you pull partying downstairs, sensible upstairs.
Oh, no. I've definitely got my suit on. Yeah, no, I've got my tennis shorts. Don't worry.
yeah. For
anyway,
that's it for Wimbledon. Yes, you change the sporting attire below. Just for,
I have to apologise. I did give you a bit of abuse last week for probing you on your portfolio, which I know you're going to reveal.
Fine. No, that's fine. Listen, I've I'm edging towards long-term investing, but having said that, I have 5 core holdings, and I know on Twitter you was talking to me saying, "What are your holdings, Justin? What are your holdings?" And you had all my previous holdings there. That I'm being stalked by Paul Hill here, but no. So essentially, my longest holding so far is Polarean. I've had it just over 2 years.
Yeah.
Second longest holding is Gfinity over a year. Escape Hunt about 10 months, 11 months.
But you're a big holder of that. You've got about over 3% of the company, haven't you? I mean, that's a biggie. That is of you.
Yeah, and what else? Escaping. Yes, TrueFin now about 5 months. And I've always been trying to find a fifth stock. I've been messing around, jumping in and out of companies, and that's why you sort of blame me for short-term trading.
I might be able to help you with a fifth stock as well.
I've got one.
Sixth one then.
Yeah, soon after I bought. In fact, I hold 6 stocks, but one's non-core, and I'm not convinced on it. And I went into too big too quickly. That's the trouble. I think you have more patience than me. You evaluate as an analyst. You take time, and you're not worried about the share price too much, and so you take time to get involved. I don't. I'm more of a trigger finger. I got to get in there. Got to shoot this. Get quick, bye. And so then I end up regretting it sometimes. Thinking, I've gone too early on this. I like the company. Maybe it needs a bit more time, and that's happened with a couple of companies. But Biome was my latest buy, and in fact, I went into that, and they did have a bit of a profits warning, but it's still no problem because I like the area they're in. They're growing very quickly. They're starting to get now towards cash generation, and they're in bioplastics and all that. But they've had problems with shipping and all this stuff. And one of their big customers was going to be responsible for the majority of their growth, because they did have their analysts had penned in 52% growth this year and 40% growth next year and the year after on new customers. These new customers had problems manufacturing, and they're completely, it's only a delay because they've actually bought a lot of kit off Biome Technologies to produce these biodegradable coffee pods. So they're going to do it's going to resume next year, but they've had a warning with that. They said now shipping, because most of their customers in the US, shipping where it would take 3 to 4 weeks, it's now taking close to 3 months because of the pandemic problems. So they've had an issue, just delays, but that's a nightmare. You buy into stock, you do your research, and all of a sudden they announce that, and they dropped by 23% in one day. It's bounced back by about 15% back up now, so it's fine. It's just delayed. But those are my five holdings. I've got another one which is non-core, and it's I-nexus, and it's a tiny sort of thing. And I'm not convinced yet. If they land a contract, it's so small, this company, it will fly, but they're not quite there. And I think, but if it's valued at 2.4 million market cap. That's all. They've got recurring revenue of 3.7. They're break even, so they're really on that cusp. Not quite there, but if they land one contract, it could do very well. So it's very illiquid. It's a tiny market cap, but I don't talk about it that much because as yet they're not quite there, and I went in too early on that one. And so
what about Ilika? Because I understand they had a big placing this morning, 30% discount to last night's close.
Yeah, that was annoying because I went into Ilika. I bought that over last year Christmas time, and I just wanted to get into something quite hot, like the EV sector, because as you know now, headlines everywhere about EVs, and it's only going one way. I got in there, and it sort of ignored valuation, which is swearing to you, really, isn't it? I sort of ignored valuation because I thought the hype was there, and it was, and it was doubled within a few days of me buying it, But then I sort of got a bit of a jitters. I thought, nice, it's now 300 million market cap, and they got revenue of 2 million. That's grant revenue. But I thought the future is bright, though. Should I hold on? And in the end, I said, no. Do you know what? I normally have a strategy where I invest in companies sub 20 million market cap. They're going to go on to become a lot bigger, hopefully, and I invested in this. It was a lot bigger. I thought, do you know what? I should have gone into this when they came on the podcast, which was a long time ago, which was when they were around about 40 million market cap. But I got out. But at the time, one of the reasons I got in, which is quite annoying, is they did a big fundraise and they said, this will now take us to cash flow positive status. And I thought, oh, that's good. I always look for that. Of course, I don't want to be diluted any further. And yet they've done another fundraise. And this is, they've got
Are you still in there or are you out? Are you out
No,
now?
I'm out completely. Yeah. But there are two parts of the business, and that is there's small solid state batteries for medical devices, all that stuff, which is, low maintenance. They can stay in these devices for years and years and years, or extreme temperatures and all that. And then they've got the Goliath side, which everyone's excited about. These are the batteries for cars and stuff. That's going to take a lot longer to get, bring online and stuff. And it's even as yet, it's not fully nailed on as to how good those batteries will be. Of course, well, anyone is not yet. We don't know yet with these solid state batteries. They outperform lithium batteries apparently, and they're more efficient, all that stuff, faster charge. But they're still at trial stage. And so they did this big fundraise and a big discount, which is quite galling when essentially they've said they had enough money to get to cash flow positive on the smaller batteries. So they've changed the narrative a little bit, I feel, and that's never nice, is it? When you have that, you're holding a company, and one of the reasons you invest is because they're going towards profitability, and then all of a sudden they change the story a little bit. You think, oh, that's not right,
Yeah.
So but my five are now. I'm convinced on these five pretty much, as much as you can be about investments, of course, which is Polarean, Gfinity, Escapement, Trufin, and Biome, and then there's non-core.
And are you going to tell people now when you're selling? Is that the idea as well?
Yeah, well, I'm going to hold it. I've said on in fact, a recent webinar and weekend video, those five companies I'm going to hold for 5 years, unless there's a major change in the story, because I don't think there should be. I mean, obviously left field things happen, but general market sell-offs and all that, there's not a point. But I've held Polarean for 2 years. I'm going for it. I'm taking a leaf out of your book. The longer you hold good companies, the better they do. And in fact, the more I read about that, do you know what? I don't know if you saw this, but I did a webinar on Wednesday. Fidelity, right? Fidelity, they have $10.4 trillion of assets under management. They did an analysis from 2000. They looked at accounts from 2003, 2013, and to see who had been performing the best. Right? Two areas came up to them performing the best: inactive accounts, where people have forgotten they'd had 401ks, and dead people. They outperformed the rest.
They did absolutely nothing
because they sat there doing nothing and let the market do its course. Of course, you have some winners and losers, but I mean, it harks back to the stories about like that janitor who, and then he died quite a few years back. A janitor in America, and he's a janitor's wage, it's minimum wage. He ended up dying, leaving 8.4 million, I think, and he just had investments he never touched for years and years, reinvested dividends. And he just, he was a good stock picker, of course, but he never sold. He had quite a few losers, but the winners, so far did so much better than the losers. You don't have to worry, because of course, biggest downside you can do is 100%. Upside is, well, it's limitless.
One thing, I mean, patience is clearly, as Warren Buffett says all the time, is very, very important for success at investing. But equally, you do need to understand valuation, and you need you basically need to be able to reappraise a company's value as it progresses its own journey. So sometimes the valuation goes up, sometimes it goes down, and concentrate more on that intrinsic worth than the share price, because you can get bombed out by share price movements, whether it goes up, whether it goes down, just on emotion. But if you focus more on the actual intrinsic worth of the business, then that sort of focuses your view on the more of the longer term. So that's how I do it, as more than anything, just getting those two things together. Just on time, if you just say, right, I'm going to hold for 5 years, I mean, maybe not. I mean, let's say for instance you held British Steel for 50 years. I mean, you would have nothing if you held British Leyland for 50 years. I mean, there's lots of companies which go bust as well.
I mean, that's my intention to get. I mean, I'm not going to blindly hold without reviewing it. Of course, every news they release, I'll be evaluating. But if it's a major change in the story, something goes not according to plan, then I'll reassess. But I mean, I think time horizons, it's like, I don't know if you saw that stat as well. I was looking at the stats there. The chances of making money, and it's a US historical, this was, and the chances of making money on day trades are literally a gamble, the 50-50. Holding a stock a year or more, there's like 68% chance of you, obviously it depends where you buy, I suppose, 68% chance of you making money. Now, over 20 years, or over 10 years, 88% chance, over 20 years, 100% chance as yet Have you obviously? I think it's an index. I think it was, or whatever. But so it just shows, time in the market. Beats trying to time the market.
Yeah, and also that hit rate goes down for micro caps and for small caps. For large caps.
Oh yeah, no. Do you know what? That's the thing. I mean, when I say these things, right? I mean, on AIM because I'm in micro caps, but there's a distinction you have to make, and that is, I'm not talking about any old resource pop and drop pre-revenue, stock. That's ridiculous. You can't hold companies like that. You've literally got to trade those, and trading is very hard. And we know from the trading platforms, the majority of people lose money trading. So I'm talking about companies that are building value, they're heading towards profitability, that have growth targets and good value, all that kind of stuff. So you've got to have quality filters. You can't just pick anything randomly, and say, I'm going to hold this forever, because of course you can't do that. You still got to have some quality filters when you stock picking, of course. Yeah.
Okay, well, I've got a sixth or a seventh stock for you, and I know I've talked about it a lot, but it came out with a trading update this week. Equals Group, okay, absolutely fabulous. First half sales increased 21%. Second quarter just blew the doors off and was up sort of almost 50% like for like, admittedly against sort of easy comparisons, because that part was during the pandemic. But when you split it down into two parts, the travel related part of the business is at all-time lows and will come back. I'm absolutely convinced about it. The rest of the business, the B2B side, whether it's forward contracts, foreign exchange, e-payments, is absolutely flying. I mean, they've won, over the last 6 months, literally thousands of new corporate clients. And that's going to just drive revenues like a missile over the next 12 months. And I've done a simple chart, and that's all you need, a bit of basics. It's on Twitter or it's on LinkedIn. Have a look, and it splits those two revenue streams. You can see the B2B side absolutely flying. And I interviewed CEO Ian Strafford-Taylor, who was actually on holiday. I mean, it just shows the commitment of the guy to do an interview with me, Mr. Nobody, when he was enjoying his holiday and stuff like that.
You were not Mr. Nobody, Paul.
Well, okay, I'm less than Mr. Nobody. But anyway, he was delighted with it, and I'm absolutely delighted with it. And what it meant then, they've been able to invest even more in the actual growth, and the shares haven't really moved. They've come back a bit.
Yeah, no, I saw that. I saw the thing.
What a buying opportunity!
I read the RNS. I thought that's very good. And then the shares. I mean, yesterday the market had a bit of a sell-off on the bigger, I thought it was a good update.
Okay.
So justified the share price going down there. So
So I mean, just to give you an indication, right? The travel-related side in Q2 of this year was 400 grand. Okay. In Q3, before the pandemic in 2019, it was 2.5 million. It was 5 times more. So when that comes back, and let's be clear about it, given the quarantine measures have been relaxed for double jabbed people on the 19th of July. Last night, the bookings for things like EasyJet were up 400% for the holidays. People are going to go abroad on holiday, and also it's going to allow business people to go abroad, because that's in the travel number as well. That is going to come back in the second half. I mean, I hadn't got to be Einstein to realize there's massive pent-up demand. So you're going to get that absolute booster of people wanting to go abroad and enjoy themselves in the second half. Plus, as I say, the B2B side is just absolutely just knocking the ball out of the park. So I gave him this challenge, this question. He doesn't like challenges. Well, to be fair, we have a good joke. And I said to him, are we going to be looking at a £10 million revenue quarter at some point over the next 12 months? And he was a bit reticent, but he says, yeah, no, it's definitely feasible, because the B2B side and the rest of the business did 8.3 million. You put that number of just, the difference between 2.5 million and 0.4, about 2 million or what on top of it, you've already beaten it. You've already beaten it. So if they hit that out the mark, they could possibly do 40 million of turnover if you put that on an annualized basis. Now, on a much lower turnover, I still get to a fair value of 70p, of an intrinsic worth of 70p a share, compared to the shares at 45p. And if I actually run it and I think I'll do this in the next 2 or 3, next 3 or 4 years, they'll hit over 50 million of revenue. I get to a theoretical value of £1.50. Now, I don't want to sound overly sort of like excited about this. I know I should just jump in a cold bath, but I think this one is really well positioned. And as I still say, it's one of my top two, sort of like smaller cap, purchases. So I definitely see people have a good look at that, because it seems like a no-brainer to me. Just if you don't own it, it's certainly something to have a good look at. So do that.
Yeah.
Anyway, just moving on.
That area that equals. I mean, it seems like I said, well placed to recover very well. But in your head, are there any risks you think that it may not happen? What's the thought? Do you go through that area? Do you have? I mean, when you're looking at companies, because I tend to be, when I'm doing research, very bullish, and then I tend to, not look at risks at all. What's your thoughts there? Anything you think, won't stop it achieving that?
The only risk I could see for some reason is that people decide not to use, online payments. Decide basically to go back to cash. Is that a big risk? Not really. No. Another risk maybe is such that basically it gets very, very competitive in that whole area of B2B. But the point is with small medium enterprises, which is where they do, the retention rate of these things is very good, and the addressable market is massive, because their main competition is not other fintech providers. It's actually the mainstream banks, who control well over 90% of all this. So it seems like easy. I mean, I don't know. We'll wait and see. There's nothing's called easy money. Nothing's is a dead cert and stuff like that. But I'm really impressed by the management team, who are absolutely committed. And as I say, for Ian Strafford Taylor to be on holiday and speak to me about the actual business is just a sort of like well and beyond sort of like the call of duty, and just shows you how enthused he is to deliver this actual the opportunity.
Where's he on holiday? Abroad?
Yeah, I know. Yeah, exactly. He wasn't even in his numbers. He comes in the second half.
I hope he's using his own product, is he?
Yeah, he is using his own product. Yeah, absolutely. Yeah. But anyway, so have a look. I strongly recommend investors have a look at that video, because Ian was absolutely fabulous. So definitely worth to. Another one which is over, to stocks to watch, which could be your number 7 or your number 8, depending on how many stocks you've got here, Justin. But is 6. Sorry,
5 core. 5 core.
Okay, so okay, so in that case, equals is your 7th. This one could be your 8th. Okay, and this is a company we haven't chatted about before, but I'll introduce it. It's called Manolete, which is a ticker MANO. Okay, now the reason why
MANO. Yeah.
Now the reason
I know these. I just during the I held these for like 5 seconds during the dash for cash crash.
Well, anyway, the reason I'm interested in it, okay, is that, like, say, elective procedures in hospitals, they've been deferred because of the pandemic. Okay, they're coming back now. These guys are specialists in insolvency. Okay, they help insolvency practitioners fund, and also they buy their cases off them to actually settle with creditors and with the major parties to run that whole insolvency process for them. And they tend to go for really quite specialist type of cases, stuff that's really quite difficult. And now that whole industry, because of the pandemic, has been pushed to the right. It's been slowed down. One, because of the huge amounts of financial support that the government's given through bounce back loans and all the other sort of corporate niceties that happen, like deferring VAT, deferring sort of like all the income taxes and all this sort of stuff. But equally, they've had a temporary suspension on winding up orders. And on that basis, it's really slowed down the whole insolvency industry. Now, the shares were trading at over £5 before the pandemic, and now are trading at less than £2.40, which is just ridiculous, okay? Particularly when, if you believe as I do, this is just a deferral of insolvencies from pre-pandemic levels to effectively when we get back to more normal times, say next year, you'll see that most of that, if not all of it, coming through. So you'll have huge pent-up demand. And these guys are in the actual perfect spot to be able to take advantage. Now, that's interesting in itself, okay, as a recovery play. These, as I say, these guys have got almost like sewed up this market in terms of buying actual insolvency cases and seeing them through to fulfillment and to actually get the cash. But how valuable is this when you talk about the shares have come down about over half now? What is the intrinsic worth of this business? Well, I've run the numbers, okay, and they did round about 7.5, 8 million of EBIT, or just slightly less than that last year. I actually think on a normalized basis, a through cycle basis, they can achieve 15 million pounds per annum of EBIT, or even possibly 20 million pounds. Now that's, again, so you run that, and how much is that sort of worth on an insolvency basis? Well, I think it's a minimum, it's a 10 times EBIT multiple, or even possible 12 times EBIT multiple. And if you do that, then on a 10 times EBIT multiple of say 15 mil, you get a share price of £3.20 to £3.90. But if you do it on a sort of like a, using 20 million of EBIT, then you get anywhere between £4.35 and £5.20. Okay. That compares to a share price of 230. So even on my most absolute modest numbers, you've got at least a 50% upside. And I was looking at the Peel Hunt number that they've got just issued recently after their prelims, and they reckon it's worth £4.20. And I would agree. I get anywhere between 320 as a low and 520 as a high, which if you put it as an average is around about 420. So there's huge upside here. If you believe, as I do, the insolvency industry is not dead and buried, what you've had is you've got a whole lot of potential bankrupt companies and director malfeasance before the pandemic, which hasn't yet been processed because courts have been closed. You've had suspensions of winding up orders. That has got to come through, like elective procedures, like basically going on holiday. People want to do it. This is another part of the industry has been slowed down, temporarily because of the pandemic, but will come back. And I think these guys are in a perfect position. And I spoke to a couple of fund managers about them, and they have the same view. If you've got,
I'm sure I mentioned these to you a long time back when the crash happened. I thought, right, I'm looking at.
You didn't mention it to me, Justin.
Yeah. No, because you mentioned it wasn't, and you said litigation. There was something about litigation. You said balance sheet issues, they have to hold a lot of cash on there or something.
You do. Their cash flow cycle is over around about sort of 3 to 4 years. By the time their first investment into that company, to the time they get realization and they get paid back, can be 3 to 4 years, etc. But if you work it on basically an IRR, return, and just look at it sort of like, that they make on their money, they make sort of 2.5 times their money from investment.
I don't think I call them Manolete though. I call them Manolete when I said it. So you
I know it's
Manolete.
It is. The fund managers wrap my knuckle. It's Manolete. Yes, it is. Okay. I'll tell you the guys.
I honestly, I not on the video. It wasn't. I talked to you. I did hold these. I held these about back then, and I didn't really understand that part of it. I thought, I didn't realize that cash cycle thing was like that, because the growth was amazing, and I was like, wow, look at that, and then the valuation didn't seem stretched at all. But now the share price has come down even further. Just look at the chart.
I know. Yeah, exactly. It looks like. I mean, hey, I'd love to be able to speak to the CEO, Stephen Cooklin, I think his name is, sort of get him on, and we can have a good chat about the actual business. But I think this looks like, again, another no-brainer to me.
Look at that. Yeah, but do you know what? It looks like they IPO'd it around about £2, something like that. They went up to like 560 straight away. They literally took off. And then they've grinded lower, dash for cash, they really crashed down. They went back up to £6. Now they're back down at 227. So they're not far off their IPO price.
Exactly. And they're a 110 million pound market cap business still. As I say, the key differentiator they have, in my view, is they're a specialist in this area who buys the actual funds. And it's the difficult cases, is the people, is where you have director malfeasance, you have areas that is a lot of uncertainty to how much money you're going to recover, and that's where their expertise comes in, to give them a better chance of actually pricing in that risk and then recovering those funds for their creditors, and they obviously take the balance on top because they're taking the principal risk.
Yeah, well, when I held one of these, someone said you should look at Begbie's trainer. And I said, well, they don't specialize so much as these guys. These guys are specialists, and yeah. So I remember having that sort of talk about them specializing, having a niche there, and that's what I liked about them. Okay, cool. Anything else, fella?
Yeah. Well, another one which is absolutely knocking the ball out of the park, and I had them on for a video, was the Avingtrans guys. They came out with a trading update this week, and that is Steve McQuillan, who's the CEO, and Steve King, the CFO. And they came out with an inline, or at least inline, if not probably slightly higher, sort of full year trading update. But the interesting bit is they've got an absolute mountain of cash. I mean, they sold off a division, Peter Brotherhood, in March, I think it was, for 35 million, made 4 times the money on that. They've got roughly around about 23 mil. They're going to get another 10 million net at least from selling some land out in Luton. That takes them, they've got to invest in their healthcare unit. If you take 3 million off that, that's 30 mil. And then if you do 2 times EBITDA, they've got about 50 million war chest to go M&A. And that's where their strengths lie, in buying niche specialist engineering businesses in highly regulated industries that demand or can be for highly challenging environments. I mean, these are the guys who own businesses that produce and develop and manufacture and also service sort of critical and performance parts such as pumps, ultra secure nuclear storage boxes for cellar fields, and also blast-proof doors and stuff like that. So it's stuff that's really nichey, high value. And Steve McQuillan, the CEO, when I interviewed him, spent about 5 minutes taking me through his actual model of how he improves those businesses when he buys them. And it's all, looking at cost, looking at pricing, looking at contracts. I mean, he's got a fantastic sort of like blueprint of how he energizes and reinvigorates those business. And again, I've spoken to a number of investors about it. I mean, including Simon Thompson at Investors Chronicle, and he's bullish on it as well. A very respected, sort of investor. You've got James Thorne at Columbia Threadneedle, who's obviously likes it, and then the guy who really knows, who I really rate, is Christopher Mills from Harwood Capital, who spoke about it 2 weeks ago, and he said, "Paul, your analysis of a sum of the parts for this, if you just look at the core business, £5," he says, "I totally agree. It ain't anything less than £5. That's just for the port." But what he then surprised and just my jaw hit the floor is they've actually got this small form MRI scanner they're actually developing, and Christopher reckons on its own that part of the healthcare business, which is basically in it all for free, could be worth £5 a share. And the shares are only on about sort of 4.20 or 4.30 at the moment, and then you've got the rest of the business is worth £5. So you could easily see the share price double over the next few years if they can actually bring that to market and make success of it. I mean, Chris does like putting challenges to the management team, so you got to take it a bit like that. But frankly, he's the best life science and healthcare expert that I know, and many fund managers defer to him for his knowledge in that whole particular area. So another very, stick that on your stopwatch list, because they're really sort of like, doing well, and they're cashed up, and they're looking at a whole bunch of different regulated industries and performance and safety critical engineering product companies with aftermarket services that they can turn around and generate very good returns. And that their track record is just absolutely blockbuster. The last 10 years, they've made compound returns of 20% per annum for their shareholders. I mean, just think of that. I mean, how many people can achieve 20% returns compared to the aim up only 5%? So definitely worth a good look.
Yeah, it's a good looking chart. I mean, it's funny looking at that. You see some drawdowns, but it's carried on up. It's carried on going.
Yeah. Another management team that is massively committed and enthused, and you just see it. I mean, I interviewed these guys again 2 weeks ago. Is the chaps from Cake Box, who are the UK's go-to provider for luxury egg-free celebration cakes. And I mean, Suk, who was CEO and founder, who I absolutely love. I mean, he's just so into these products. I think he's in his mid-60s, but he's just so passionate about the business, and he's about to release his vegan version of the celebration cake with proper vegan cream, which will be just absolutely great, I'm sure, because he spent so much time on it. And so he took us back to the sort of the new products and the direction of the actual business. And then, you know, the other founder is Pardit Das, who's, you know, who took me through how he sees that trajectory through working through the financials. And I think they have a store footprint of around about 160 at the moment, sort of locations, with a few sort of kiosks and stuff. They want to double that to sort of 400 in total, and that could just absolutely propel, you know, the shares over the next 3 or 4 years. And that's just in the UK. Never mind franchising their model overseas in places like India, America, perhaps. And yes, the shares have done well. I mean, I think they listed about, you know, sort of 3 or 4 years ago at 108, and they're currently at 30, I think about 320 or something like that. And that's well deserved, well underpinned. But I could see if they do hit, you know, the sort of the targets. I was running the numbers, and I reckon they could hit sort of like potentially sales of 50 million on that sort of store footprint of 400. EBIT margins are 25%. You put a sector multiple on, you get £6.25. And again, that's almost double your money, you know, sort of like over a 3 to 5 year period. And that's not a stupid place to put it, because these guys are absolutely the go-to. They dominate the industry. In fact, they're so dominant, they've got some quite visuals on their color scheme of their stores. Have a look at it. It's sort of like purple and
yeah, it is. I mean, it does stand out. I mean,
that's the whole point. It stands out on the high street.
That's a bit.
Yeah. But one large supermarket is, because it wants to do egg-free celebration cakes in the cake box, etc. Then it's actually using that livery. I don't know how they could do it, but they're copying that flipping livery, and it isn't actually cake box. So I mean, I only know because I go online with the same supermarket, and anyway, such is life. But they are the absolute. They're effectively the Amazon of, you know, sort of celebration egg-free, you know, luxury cakes. There's no doubt about it. They are the.
Do you know what? I'm going on holidays next week. I'm going abroad, and I'm trying not to eat too much before I go away. Because obviously,
where are you going to?
Originally was Portugal.
Yeah.
But then we changed to, because they came off the green list, and then we changed to Mallorca now. But now, because you double jab, doesn't matter. You can go back to Portugal. So I want to spend 2 hours booking it, 2 hours changing it on the phone, and now we could just stay where we were. But there we are. But yeah, but those cakes are tempting me because I've not been eating a lot. Been trying to, you know, get into my bikini. You know what I'm saying?
I'm sure you look very svelte like.
Yeah.
Another one to keep on your watch list, and I've mentioned it a few times in terms of, I had these guys, they IPO'd about, I think it was end of May, is Belluscura. Now, they've had a couple of reach announcements, which are usually sort of fairly low level, but they're quite significant actually. They're filling out their distribution footprint. The first one was on the East Coast. They've done another distributor in the Midwest, which is great. So they're getting that. But what was really interesting that I saw was that the US Medicare and Medicaid sort of like authority, which covers roughly around about of medical insurance, roughly around 37% of the US population. So we're talking of a huge purchaser of medical devices and drugs and stuff across that whole country. They've said that they're extending the use of portable oxygen concentrators to more home use, to more domestic, and the reason is because of COVID, and they want to free up the scarce beds and the resource in hospitals, because obviously people, if they're on oxygen support with acute conditions, etc., are taking those resources. And if you give them a portable oxygen concentrator, so they can treat themselves at home at a much lower cost. That could really provide a rocket booster for Belluscura's sort of like patented flagship product. When they're soft launching it this year, but hard launching it next year, that could just be perfect timing. They're putting that through sort of like consultation at the moment, Medicare and Medicaid. But I think if they've put that to consultation, that means it's going to happen. It's a matter of when, not if. And as I say, that could just be huge amounts of demand if they provide government insurance cover for portable oxygen concentrators in the US, and Belluscura have got the volume. I mean, they could just see a huge demand. That's just from the US government, never mind from other countries like, India and, the emerging markets who desperately need to free up their hospital space. So I thought that was really significant. And I'm almost surprised they put it out as a sort of like a REIT. I know it hasn't had a material effect yet, but that's like it won't ever make a material effect until it's finally sort of rubber stamped. But that really puts a sort of like a very strong backdrop, and really sort of again highlights the applicability and of that particular product, portable oxygen concentrators to help people with maybe COPD, respiratory conditions, COVID, all those kind of acutes that currently are blocking beds in hospitals and can be obviously treated at home. So really sort of like another example.
It's odd where we are with COVID in this country, isn't it? I mean, obviously, I don't know what you think about the figures, but obviously vaccines have an effect. And if you look at it, roughly, pre-vaccine, 10% of people who were getting it was in hospital. That was 10% of the overall cases. Now it's down to 1%. So that's fine. But they're saying, so we are at about, we're about 400 people a day now. It's just hit the new sort of high going to hospitals. Previously, it was literally 4,000, the peak. But they're saying 100,000 cases, which means 1%, 1,000. Yeah, but there seems to be a part of me. But if you look at the ONS stats, 9 out of 10 people now have antibodies in the UK. I think they're almost trying to go for herd immunity over the summer, or trying to get it up there. I think UK is almost a test case for this, but it suggests to me, like you say, the testing isn't going away for a while yet.
Yeah. Well, I mean,
I think a million a day they're doing it in this country now. A million tests a day.
Over a million a day, and also, Justin, when you go on holiday, whether it's Mallorca or Portugal, you're going to need a PCR.
Yeah. No, who are you going
to go to? You're going to go. Yeah. You're probably going to be using SourceBio's facilities through somebody like Boots or whatever it is like that. Yeah. So all I would say is that, I mean, I've actually sent that announcement from the BBC. It was on BBC News about, overseas holidays jumping up by 400%, or the bookings jumping up by 400% to the exec chairman, Jay LeCue, overnight. And he came back and said, yeah, it's great news for the business. So, I mean, I think that will just, testing, you say, is not going anywhere. That's really good for, SourceBio with its leading PCR tests. And, we still need, I keep banging the table, we still need a therapeutic to be able to help the poor people who have got compromised immune systems, who have got no antibody protection, regardless, it's going to kill them, basically.
Yeah.
So when they get it, they're going to be rocking up in hospital. Even if they had a vaccine, they're going to be rocking up in hospital. And on that basis, we need somebody to treat them. And as I say, I'm hoping that Merck's new sort of like novel drug will be able to do that. Or even, we talked about Remdesivir from Gilead, which again I own. That was shown to reduce, sort of fatalities by 70%. For patients on low flow ventilators. I mean, that's going to be that useful. It's like steroids, but we need something. So we're still not.
I just think it's interesting how much they're going to let this go. How high can infections get before? Because let's be honest, 4,000, the NHS is struggling. 4,000 people a day going in, we're struggling. We're at now 400. But when does that get to a bit of a strain? They start locking down again. If they do, I don't know if
well, in certain parts of the country, the answer to that is it's already a strain, because they want to get through the backlog of elective procedures, which has now hit 5.3 million people. Yeah. So to get through those and to allow those, unfortunately, the poor sufferers some sort of medical treatment, then they're going to have to sort of ramp up they're basically those whole operations and stuff, whether it's knees, hips, screenings, blah, blah, blah. So that's happening already over the weekend.
I talked to Wendy Lawrence actually from Totally, on the podcast.
What did she say? She
said it's funny actually, because the results are good, the results are out, but we're gone. And I said to her, you've gone from being sort of super busy with COVID to now being super busy with your normal kind of business, haven't you?
Yes.
Because you've backlogs. Yeah. I mean, when she said to me, back to normal. So it was not normal for us. It's a new normal of heightened activity completely, because there's so much backlog. So we're going to be busy for the future. So if people are seeing these as exceptional results because of COVID, no, it's going to be continued for, because we're not going to calm down. It's hands to pump non-stop,
Yeah. And the final last one was, I mean, I don't think I mentioned it, was, you know, LungLife. I interviewed the I only interviewed the CEO this morning, Paul Pagano, who's absolutely terrific, PhD, really knows, you know, they are effectively trying to solve this whole problem of lung cancer detection and diagnostics, and they're a sort of like a next generation testing or diagnostics business based out on the West Coast. They've got proprietary patented technology, but they're effectively their flagship test, which they're putting through a validation trial. They've already done pilot trials which show its accuracy, its predictive accuracy is 89%. And what you can do is such that if you basically diagnose a patient with with lung cancer early, you can improve obviously the survival rates, but you can significantly reduce the whole medical costs associated with it. And if lung cancer is the biggest cancer killer in the world by a mile, you know, there's like 1.8 million people who die every single year of lung cancer, and about well over 150,000 just in the US. And in the market, they reckon the market out in the US is roughly around about $3 billion. And if they get sort of only a 5% market share ultimately of that, you could see, I ran the numbers, you could see this share using a modest sort of 5 times sales multiple compared to the industry on 9 times. You could easily get this, you know, LungLife shares could be over £20 in 5 or 6 years. They're currently trading at £2. So it really is a sort of like, you know, excellent technology. And their key differentiator is they use these circulating tumor cells to be able to, which is effectively like the closest you get to actually accessing what the tumor is. And they use those out of a blood test, a blood draw, to be able to see whether this patient has actually got early stage lung cancer, because that is really sort of the goal, trying to find that whole diagnostics. The standard of care currently is a CT scan, which is only 60% accurate, and this is like 89%. And then they're putting AI on top. And the whole reason of putting the pattern recognition in, because they've got a huge and growing biobank of information of blood samples where they get this information from of circulating tumor cells. The whole idea is to improve the speed of diagnosis, but also improve the accuracy. And if they can get that sort of accuracy up from, you know, over 89 into the 90%, I mean, it'll just be absolute. That mean that, you know, 9 out of 10 people basically are going to be correctly diagnosed early, say 2 or 3 years early, whether they've got sort of like either benign, you know, sort of like tumor, or whether they have a malignant or cancerous tumor to be able to then, you know, sort of like use for treatment, or, you know, whether it's surgery or whatever like that. So they've got really good technology, came onto the market, IPO'd yesterday, raising 17 million at 176p. So they look a good share.
Yeah, no, I like the sound of that. I mean, you know, like I said, cancer, spend on cancer is absolutely huge. It's a massive problem. And, you know, do you know what? In fact, I can't not mention Polarean off the back of that, because they probably work in conjunction there. Because I don't know if you saw this week, but the University of Texas, MD Anderson Cancer Center.
Yes, absolutely.
Yeah, it's the largest center in the US, invested like over 800 million in research in 2018, but they installed one of Polarean systems in their center there this week. So that shows they are pioneering thought leaders, these centers. When those people adopt technology and do papers, release papers, generally every other hospital will say, go by them. You know, they'll say, yeah, okay, listen, the papers that come up from there. So yeah, I mean, and in fact, that's what Polarean is going. They're starting off a very high level. The big centers that have the money, the research, the budgets. They're installing research modules into those hospitals, and then it'll sort of filter down to other hospitals. But
you raise a really good point, because when it comes to sort of investors, and I'm asked this question many times, what do you look for in healthcare and medical stocks? I always say, go for best in class, go for the best technology. You know, obviously got to be at the right price, and LungLife is definitely a sort of like a very, very reasonable price. If you think about it, it could be £20 compared to £2 now. But their sort of technology, look at what they've actually done, their endorsements. You've got Mount Sinai, who's absolutely sort of like, you know, gold standard into sort of like, you know, in medicine out into the US. They've backed them both, not only with their capital, they own about 9.7% of the actual shares, but also with their expertise and resources for their biobank. So they believe this test that LungLife is doing is best in class. And if they believe it, I mean, I've come across Mount Sinai on numerous occasions with Verici, with Renalytics, with sort of like EKF, with lots and lots of other sort of like real world leading medical businesses. So they absolutely know. And these guys tend to only back sort of like horses that will actually win. But not only is Mount Sinai on board, if you look at the capability of their science advisory board, it's a who's who of industry heavyweights and experts who are advising the company about how to best develop this or continue developing it, go through the validation test and get approval from FDA and then commercialize it. So when you have that expertise, and they're frankly not motivated by money, they are motivated because they want to bring a winning solution to solve a real medical problem across the world. When you get that kind of backing and endorsement, then you know the technology has got to be best in class, and that's what they have. So I think a lot of investors can take a huge amount of reassurance that if they don't really, they understand the top level, but not the detailed sort of like molecular structure DNA, then these guys, have kicked the tires on it. There's nobody else in the world with a better view in terms of whether this is going to work or not in the real, in the field, in the real world.
Yeah, very interesting. They're on my watch list. I'm watching them, but at the moment, my big hold is Polarean. 3 months off from FDA approval there, so I'm going to wait for see what happens there. And yeah, but I just think the medical area is massive, isn't it now, especially in these areas? And people now realise, that to go through COVID, how much more research investment needs to go into the medicine side of things. And so I think it's a very good area. Marvelous stuff, Paul. Thanks for that, fella.
Have a great week. When are you off on holiday, by the way? When you going?
Week after next. Week after next. In fact, do you know what? Apparently, on the 19th, when I'm going, there's going to be a week's heat wave in this country.
Oh, is it? Okay, well, good timing then.
I know, that's always annoying, isn't it? I want to be peeing down my rain. That's what I want, in this country. Marvelous. Thanks for that, Paulie. Speak next week.
Yeah, look forward to it. Cheers.